Uh, so we're just going to let Randy go first here. He's got a few new strategies he wants to talk to us about. And we've had him a couple of times before, and everybody usually likes his presentations and his strategies. So we're eager to hear what he's got in store for us tonight. So I'm just gonna go through a couple of things here and then we'll get right over to Randy. So again, everything we say tonight is under this disclosure. You know, it's for educational purposes. Anything you use at your own risk and do your own independent assessment. Okay, that's about all I'm going to go through now. So I'm going to stop sharing and it'll be over to you, Randy. So you're ready with your slides?
Yeah. How do I
So at the bottom there should be a green share screen.
Oh, button. Share screen. There we go. Got it. Okay.
And then when you select your oh, you got it all. Okay, very good.
All right. Well, thanks for having me back, everybody. I have quite a few people from your group who subscribe to the monthly reports I put out for the strategies I follow or track, and had some changes recently. And one of the people had asked that I might be able to come back on to go over some of those changes. So what I've got tonight is kind of a three little thing here: the 3 deprecated strategies, the 2 new ones, why that kind of happened, and where that leaves us right now, and then how things look year to date. I've got a lot of slides, but I'm going to be, I think, a little quick going through this. So, whoops, there we go. We just saw this a moment ago, so I'll just skip through that and hope everyone understands. Whoops, it's funny. There we go. So if you haven't seen previous presentations that I've done, or possibly other people, on dual momentum, what is dual momentum? Well, it's really just a combination of 2 types of momentum. Generally speaking, you'll have one benchmark index that you're looking at, and if it shows a positive momentum over a look back period, then you invest into equities. There would normally be 2 or more different possible equities to invest in. And then the second momentum is you pick one of those components, the one that has the highest relative momentum. If your benchmark index does not exhibit momentum over the look back period, then you would go into treasuries or bonds. And as Gary Antonacci has kind of not prescribed, but how, you know, the basic way that he has done momentum investing, dual momentum investing, as he's talked about, it works best with large geographical regions, not more specific investment options. What's dual momentum system special sauce? Well, one of those I just mentioned about the large geographical areas. I do a shorter multi-period look back in my strategies, and they provide better alternatives than a 1-year look back, insofar as it lets you go more granular than just investing in, say, the US. You can pick a sub index within the US, and it handles that really well with my look back period. The other thing the look back period allows for is smart leverage, which is a way that I'm able to leverage up the strategies when it's most in our favor. So we try to stay out of leveraged investments for the most of the time, and just go into them when we really have an above average probability of doing well in them. So 3 deprecated strategies. This is what it looked like previous to the changes. I have 2 strategies that never use leverage: Triad, which is kind of I would call it a better 60-40, and the Russell Original, which uses no leverage. I had these 3 funds, strategies that use smart leverage: the Global Navigator, four strategies: Global Navigator XL and Russell XXL. And the XL and XXL, that was kind of my nomenclature for going more aggressive when you're out of equities into treasuries. The XL would go into extended duration treasuries, and XXL would go into TMF. And then the always 3x leverage strategy is Max Payne. Global Navigator and Russell, those two variations, they really were similar. The main difference between them, other than the Russell XXL going into TMF instead of EDV, is that the Russell was strictly US based. So it would look at 3 sub indexes within the US and pick the one with the highest relative strength, go into that. Whereas the Global Navigator is more similar to Gary's Global Equities Momentum Fund, where you're in the US if that's the highest relative, or you go into the foreign markets if that were the other, the stronger of the two.
Yep. Randy, I was trying to admit somebody and I muted you again.
No problem. Did you guys catch you got through this page?
Well, I think we missed just maybe a minute or two.
Okay, so I was just commenting on the second bullet there that essentially Global Navigator XL and Russell XXL, they were very similar strategies. The main difference being that the Russell was strictly a US based strategy. It would look at 3 sub indexes within the US market, whereas Global Navigator would invest either in the US or in foreign markets if they had the higher relative momentum. So why did I get rid of those 2 strategies? Well, and the answer is tax efficiency. So I happen to be a person that, not that I have vast buckets of money lying around, but most of what I have as far as equity investments is in retirement accounts. And so I have a little different perspective than people who have a substantial amount of money that are not in equity, I mean, in a retirement accounts. So I had a couple people come to me and say, hey, is there a way you can make strategies like the Russell and Global Navigator more tax efficient? And that's what kind of drew me to the new LT gain strategies was really just tax efficiency. The list on the left. So essentially, I was not originally looking at a dual momentum option to try to get more tax efficient. I was really just looking at some common strategies, and I wanted to see how they looked compared to each other and kind of give me a starting point. I was looking to do a new, more tax efficient strategy, not necessarily so similar to the strategies I already had though. So obviously buy and hold was not really a consideration. I can't take those drawdowns, but I looked at the 200-day simple and exponential, 10-month, which is very, very close to a 200-day, relative strength, adaptive, target vol. And as it says on the right there, what I was really looking at was the compound annual growth rate, the max drawdown, standard deviation, Sortino. And I didn't look at it for all the strategies, but as I kind of, in my estimation, the 200-day was actually the winner of those strategies, investing in the US markets. And I was really looking at the CAGR and the drawdown to come to that conclusion. So I didn't really go into it on the slide, but why not just go with the 200-day moving average? Well, the answer is I was trying to boost the returns, not necessarily with smart leverage like I've done in my other strategies, but I wanted to be able to try to get a little more leveraged when it was in your favor. And when I was using the 200-day, I just couldn't find an alternative that I came up with that worked very well. You know, like I was looking at the golden cross and the death cross and all these sort of ways of protecting yourself. if you've amped up the leverage. And I really couldn't find anything that I was happy with. The drawdowns just went sky high when I was trying to do those. So I started thinking, you know, how else can I approach this beast of trying to get longer hold times and getting more long-term gains. And in general, the reason dual momentum tends to not have stellar long-term gains is because of that second, the relative strength aspect. So whenever you have two or more investment options that you're considering to invest in at the end of every month, you're going to switch off, right? So look at the Russell, especially where it's a US base, and you have the S&P, Russell 2000, and I can't remember offhand right now, Russell, either mid-cap growth or mid-cap value. But those are different, but they're all kind of similar too. So you can easily imagine that every few months you may pop out of one of those and into the other one. The traditional like global equity momentum, from Gary, or my global navigator, they have a little less switching because you're going from US to foreign, but they do still pop up and down every once in a while, even if it's only for a month or two. And as I thought about that, I thought, well, gosh, what if I use the base model of a dual momentum system, but only use one investment component, the US market, instead of multiple? So you see, I scratched out dual at the top and put in single. It's really a single momentum, right? So I took the US market, did my weighted multi-period look back, and I use Portfolio Visualizer a lot when I'm just playing with stuff to look at quick numbers. It's easier than doing it on my own. But from 1994 through current, that method of just having the US market compared to a 200-day simple moving average, it was just a little bit worse, not significant. Well, okay, so then I thought, well, maybe this will work. And so then I brought it into my model and put in smart leverage, which is when the market has a 15% or greater drawdown at the end of any month. The next time we go into equities, we use leverage. And excuse me, because there's only a single option, right? Single momentum, we don't have multiple things to look at. I realized that you could potentially have very long periods of time when you were holding the leveraged ETF. And the real goal here was to make it more tax efficient. So I thought, why not, if we have, so look back in 2020, I forget, maybe June, I think it was, when my strategies got back into the market. Had we had this LT gain strategy back then, we would have gone into leverage in June, and it would have held, I believe it held all the way for the next 12 months. On that 13th month, we're going to sell it and go back to IWB, the Russell 1000. And it's just to get out of the volatility of being in leverage for too long. So how does it work? Well, so on the left, I show LT gain 2x with and without smart leverage. And you can see there's 508 months that I have back test data for. On the no smart leverage, 29% of the time is in treasuries, 71% is in the Russell 1000. And the summed gains, meaning just I added up all the gains and losses for every one of those 508 months, and it was 631%. When we throw smart leverage into the mix, you can see the treasury stays 29%, no difference there. But now 22% of the time, we are in SSO, 2x S&P, and then the remaining 49% we're in 1x. You can see that increases the summed gains over that time from 631 to 831, a gain of 32%. Well, that's a huge gain. On the right-hand side, these are the quick stats I look at for every model I do. It's just a quick and dirty way for me to get a sense of where it is. So you can see on the top group that starting with the 6.67, that's the average month between change of investment in LT gain without smart leverage. If you look down below, you can see with smart leverage, that period decreases a little bit. It's actually a 7% decrease. And that's because we're adding in switching from leverage to non-leverage, whereas the without doesn't have that change. But the CAGR, you can see, goes from 15% up to 20%, a 32% increase. The drawdown over this period of time didn't change. You obviously have a higher likelihood of a bigger drawdown with the smart leverage because you could get caught in a drawdown situation while you're leveraged up. But in general, the ulcer index over what is that, 42 years, it only went from 5.26 to 5.6, which is a 6% increase. So the big numbers I look at, 0% change in max drawdown, 32% better CAGR, and only a 6% worse ulcer index. I mean, that's good numbers in my opinion for adding the smart leverage in. So I just thought I'd go back and show you over the whole back tested period, how did that 12-month filter play out? And what I mean by that is by exiting the leverage after 12 months when you can lock into your long-term gains. So there were 6 periods of time from 1980 forward where we exited a holding early, after that 12 months. The first one you can see was in 82. And if you look at on the left, you'll see in the Excel spreadsheet there, lines 49 and 50. Then if you look over to the returns column, which is either green or red cells, you can see this one worked out in our favor because even though we exited in August 83, the next 2 months had a net loss. And then the strategy went back into treasuries in November 83. So had the strategy stayed leveraged, we would have been a little worse for it in this first example. This is the second one. Very similar situation. We get out after 12 months, and the next 4 months have I don't know, I'm spitballing here, maybe a 4% loss before it went to treasuries. So again, we actually won here. We would have lost double that had we been an SSO before switching back to treasuries. Here's the third one. Actually, again, same way. We came out a little bit better for switching after 12 months. This next one, we came out quite a bit ahead because it just so happened that 13th month, we would have been holding a leveraged ETF. We would have lost an additional 8% roughly. Okay, this one finally went the other way. We would have been better off had we stayed leveraged. The next 3 months were all winners of roughly 10%. So we would have made an extra 10%. And this is after the pandemic dropped down in early 2020. This one, you can see, what is that, 8 months, it held IWB after it got out of SSO. And those months from June 2021 to January 2022, it's about 6.7. So we would have been better off, 6 to 8%, depending how it worked out exactly in the 2X. But you can also see we reduced volatility substantially too. I think that's got to be the last one. Whoops. So 12-month filter quantified. What are the real changes? So the top several lines there for the 2X version. From 1980 forward, and sorry, these numbers vary a little bit different from a slide I showed you earlier. It was because I did one of these a little before the month closed and one, I think, a couple days after. So the numbers are very similar, but a little bit different. But you can see the CAGR is just a hair under 20. max drawdown 23, and the Ulcer Index 5.59. If I remove that 12-month filter and just let it stay in leveraged 2x S&P until there is a change out of investment and into treasuries, the CAGR goes up just a little bit. It goes from 19.92 up to 20.37. Drawdown did not change, but the Ulcer Index went up to 6.57. So in percentage terms, the CAGR increased 2.25%, but we had a 17.5% increase in the Ulcer Index. I'm not going to read off the numbers here for the 3x, but a similar situation. There was a 3% increase in the CAGR over that time if you took the filter off, but it came at a 30% increase in the Ulcer Index. So I guess at the end of the day, if I look at these numbers personally, and if I'm inclined to be in the long-term gain 3x strategy, and you know what, I'm sorry, that something I just realized, that max drawdown for the bottom line there, it's not 3.53. I think it's 33.53. Sorry about that. I realized I didn't type that in right. But going back to how I would look at this personally, if I'm looking for max gains and I'm not very sensitive to drawdowns, don't worry about the 12-month filter. Let it ride in the leveraged fund until you get out. But if you're someone like a lot of us who has an aversion to drawdowns and volatility, then use the 12-month filter and get out after 12 months, lock in those gains, deleverage, de-risk a little bit, and wait until you have another smart leverage opportunity. So the Russell had three components it was looking at. LT gain is really just using the Russell 1000, and it goes into SSO when it's leveraged because there's no Russell leveraged option. But you can see it's ironic how extremely close they were in performance over time. This is from 1980 forward. Almost, I realize it's a little up and down along the way, but almost identical performance over such a long time period. So that was really encouraging to me when I looked at this, when I got to think about replacing the Russell with a new strategy. And this is showing the Russell, but now the long-term gain. Well, I'm sorry, both of them have tax effect taken into them. So I went through all the performance from 1980 forward, and I applied the capital gains long and short-term rates of 24 and 15, which I assume is what a lot of people are likely to be using. And on the right there, well, first of all, the chart, you can see, let me go back up really quickly. You can see, for example, where was it here? Look at, I'm spitballing, but it may be hard to see on your side, but from about 1999 through 2010, you can see that gray line is under the red line, kind of in the middle of the chart. It just, the Russell was doing better relative to the LT2X over that time. But now when I switch down to the new one, you can see it's up, it's mostly even with it over that time, and it's higher before and higher after. So, and also let me go back up one more time. It's hard to see, but this ending balance is actually for LT gain is 5% less than the Russell was over that whole period. And you can see here it's clearly quite a bit higher. And that's just the effect of the taxes going in. So I actually went into each time investments were traded, and I applied a short or long-term gain, capital gains tax rate to those to give them a haircut, bring them down. And you can see over time, it makes a pretty dang big balance over a long period of time. The Russell over this time period, I think it was $10,000, becomes 7.1 million, and LT gain goes up to 8.7, right? So the CAGR reduction is smaller. You can see for the Russell, it was 17% reduction in CAGR, but for LT gain 2X, it was less than a 14% reduction. And that's strictly because it has more long-term gains than Russell. And it's actually a pretty large, it's a pretty big amount difference. This is for the people in the high tax bracket, 41 for short and 24 long-term. Very, very similar than the previous, but you can see that the effects are even more pronounced. The higher tax rate you're paying, the bigger you're going to save with the long-term compared to short-term. Only makes sense. But you can see it play out over time here pretty easily. So kind of summing up on those old versus the two new LT gain strategies, the Global Navigator XL and the Russell XXL were very similar. And I ended up replacing them with the LT gain 3X. LT gain 3X uses extended duration treasuries when it's out of equities. The ticker is EDV. And interesting, I was curious just to see how it would have done. And like the Russell XXL, if I go into TMF for the first month of LT gain 3X, it actually outperformed both of those strategies over the period of 1980 forward. I just thought, let's use a little prudence and keep it just in EDV. But going more risky on that first month of treasuries has paid off over time for sure. And as I showed you on those previous charts, LT gain and the Russell were so similar. The format that you guys get all your monthly data that Don puts together, it's really conducive to looking at a lot of strategies. And if you've seen my decks, you know I do it a little differently than Don does. I'm not saying it's better or worse, but I'm more visually oriented, I guess, and I like to see the charts, and I want to see kind of fact sheets like a mutual fund or something would show you. So for me, it's cumbersome to try to have an ever-growing number of strategies and report on them meaningfully so that people will actually look at it and not get drowned in the detail. And it was really for that reason that the two new strategies were so much more tax efficient, and they really seemed to perform well. So I got rid of those three strategies and replaced them with LT gain 2X and 3X. And I was just talking about trying to report on strategies in the way I do with the charts and everything. It just seemed like this cleaned it up a little bit. I didn't have so much overlap. The Global Nav XL and the Russell XXL did. It's a more friendly lineup. It's simpler. It's one less strategy. Triad and the two LT gain are all three very tax friendly, and Global Navigator and Max Payne are best used in tax deferred accounts. They're not tax friendly, or not nearly as tax friendly. So are we in trouble with treasury yields rising? Well, look at that top line. In short, I hope not. I really hope not. This chart on the left from Macro Trends is a really nice chart showing 10-year treasury yields from, I don't know, in the mid 1960s, I think, all the way to current. And I happen to have Global Navigator results from 1970. Well, if you look at this chart, maybe not the first year or so of that 1970 decade, but you can see definitely for the bulk of that decade, we had very much rising yields on treasuries over that time period. And if you look at the equity chart on the right, the light blue line is the NASDAQ 100, the thick blue line is the S&P, and the dark line is Global Navigator. And you can see the first inch or so of that left side of that black line. It did very well in the 1970s. And what surprised me, I wanted to make sure that it was the reason we did well wasn't because treasury holdings did really bad, but the stocks did really well, or we didn't hold treasuries very long, that kind of thing. So I looked, and much to my surprise, we actually held treasuries 49% of the months during the decade of 1970. And if I look at 1980 to current, it's only 29% in treasuries. So not only did the strategy not blow up in that decade of rising yields, but we actually held treasuries a lot more than the strategies would have since. Just to show everybody where I am personally, as of the end of February, this is between retirement and non-retirement, but 39% of my investments are in investment real estate. That's not counting my residence. 61% are in equities. And if I look at that 61% as a 100% pie, I've got 6% in Triad, 8 in the original Russell, 17 in Global Nav, 23 and 10 in long-term gain 2 and 3X, 9% in Max Pain. That totals up to 73% of the 100. I've then got 19% in Profit Farmer, which I'll come back to in a minute, and 8%, which is S&P-ish. And by ish, that's my current 401k and a 529. I just can't effectively do strategies in those accounts. I'm limited to how often I can trade them, and it's just not easy. So I have a little bit of bonds and little international and mostly S&P in those accounts, and they're just buy and hold. I'm not going to really go through these, but if you don't get my monthly strategy, this is one of the first pages in the deck that I think is really important. It shows the last 12 months monthly returns for the 3 benchmarks on the left, and then my strategies on the right. It shows the monthly the percent return, the equity data down below, and then I chart that equity data on the right. Obviously, you can see this year to date it's been a hit, but that's all there to see. Similar to the last one, which was 12 months of data, this shows from 1980 forward for those same benchmarks and for my strategies. And at the very bottom, it shows for the current year how the strategies are performing compared to the S&P, and then what the overall CAGR is from 1980 forward for those strategies. This sheet shows the past 12 months where we have been in each strategy, in what equities, ETFs, I mean, and which periods of time, and then where we are for the month ahead. So this was from the February deck showing for March. So that bottom line shows where we are going. Anytime one of those entries is bolded on the bottom line, that means it's a change. So you can see for Max Pain, it was in 3X long-term treasuries in February, staying in treasuries, but it de-risks a little bit to EDV for any subsequent months it's in treasuries. Whoops, sorry. I took this screenshot at the end of the market today. I have a little Google sheet where I track, and this is available on the Dual Momentum Systems website. It just shows where we are for the day, month, year for each strategy, the benchmarks, and then it also shows where we stand year to date to those benchmarks. I have a regular 6-inch, phone. I don't have a giant phone. So on my phone anyway, when I look at it in the standard upright position, I only see through the year column on the right. But if I twist my phone horizontal view and scroll it up so I can see everything, it then shows that year to date plus and minus any index it's tracking. So year to date, on a relative basis, Triad is doing fantastic. It's almost 3.5% better than its 60-40 benchmark. The reality is it's still down 3% for the year. So a relative win, not an absolute win. And as of the close today, the next 4 strategies are basically just a hair under the S&P for the year. And Max Payne is the one that is quite a bit behind, and it's because that's the one that's virtually always in 3x. So I just looked at my phone. If you saw me look away, we had a little news tonight that Putin's Russia is bombing the largest nuclear reactor, which is in the Ukraine, and the markets tanked quite a bit earlier tonight. They were down, the S&P was down 1.65 when I looked. It's currently down a little closer to 1% now. But who knows where this will end up tomorrow. You guys have witnessed firsthand all this volatility recently. But as of right now, not at the end of the closing day, but the futures market right now, with the exception of Max Payne, all the other strategies would gain, well, I shouldn't, sorry, Russell OG, Global Nav, and the two LT gain strategies would all be almost 2% higher than the S&P if the overnight numbers hold where they are today. Don't know what that'll be tomorrow, though. This page and the next page, this is a little different. I don't actually, I mean, this is in my model. But I don't publish this in the monthly deck, but I mentioned how I invest my money, and I mentioned that I do 19% into Profit Farmer. This fact sheet shows Profit Farmer compared not just to the indexes, but also to Max Payne. I'm not going to go over it in detail, but if you look at that block of numbers on the left, it starts with annualized returns. The next one down is maximum drawdown and the Ulcer Index. If you look from the column of May 1987 forward, and that's an odd date for my strategies. You know, I try to go 1980 forward. I just don't have the ability to do Profit Farmer before this date. But if you can imagine, it has returned almost 40% from the middle of 87 forward, which is just mind-boggling to me. It handily eclipses Max Payne's performance of 31% over that same time period. And in the next group down, the max drawdown, it's 49% for profit and 67 for Max Payne. You can see the Ulcer indexes, they're high, but it's a little worse, obviously, for Max Payne. The equity charts on the top, drawdowns on the bottom. If you look at the far left at that hot pink line, you'll see that Black Monday, October 87, Max Payne got absolutely eviscerated. It lost 63% that month, being in 3x equities on a 20+% drawdown hurts when you're in 3x. Profit Farmer was 95% in real estate that month, so it did not fare nearly as bad. That doesn't actually give me confidence that if we were to have another flash crash type event of a large proportion, I don't necessarily think that profit would do significantly better than Max on a drawdown like that. It could, though. That's the thing. It could, because it's usually invested in 2, if not 3 equities at the same time. Not always, but it kind of spreads that risk a little bit. But let me just pop up real quick. You can see the strategy components kind of in the middle right section there. Well, if it happened to be in TQQQ, URTY, and EDC, and when one of those events hit, it's going to drop just as much. And it certainly has months where it holds all of those. So anyway, I don't mean to hail Profit Farmer as being impervious to drawdowns. It just happened to happen, that particular one, much better than Max Payne. And if you look at the drawdown chart, it's interesting. Max had some really nasty drawdowns for a long time there as it was trying to get back. In the Great Recession from 07 to 09, Max Payne actually outperformed by a wide margin Profit Farmer. If you look at the equity chart up at the top, you'll see it was continued to go up when Profit Farmer went down. And no surprise, the drawdowns were worse over that period for Profit Farmer. And then currently on the very, very far right, you can see Profit is having a worse time a month or two than Max were. But I use it. I'm invested in it myself. When it comes to these really turbocharged funds like Max and Profit, I want to diversify a little bit. I'm not comfortable putting it all into one or the other. So I put a bit more into Profit actually than I do Max, but I'm in both, but I have more of Profit Farmer. And I just thought it might be interesting to this crowd to see those charts there. That's what I have. Just a call for help. If anybody is really proficient with RapidWeaver, I make no bones about it. I'm not a web designer. My website could use help. If you have the expertise and the time, I would love talking to you. And with that, I'll open it to questions.
Well, thank you, Randy.
Yeah.
So anybody have some questions for Randy?
Yeah, Randy, this is Randy Curry talking. I really enjoy your presentations. I think they're a great alternative to the kinds of things we're doing.
Thank you.
I do get your monthly slide deck, so I see what's going on. The one thing I haven't seen on there, but maybe I'm missing it, is what are your rules for going into smart leverage and out of smart leverage?
Yeah, so I think it is in the deck somewhere, but I fully understand there's a lot of data in that deck. And but the rule for smart leverage for all the strategies is like a lot of technical asset allocation strategies, mine look at the end of the month numbers. I mean, I personally look intra-month, but it's only out of curiosity. I look at full month end total return data to make the well, they're all objective. It's not subjective, but I put all the data into my models, and it tells me what's going to happen. But the rules that I've given it to abide by, for Global Navigator, it looks at VTI, which is the total US market. And for all the other strategies, they use IWB, the Russell 1000. So if those benchmarks have a 15% or greater drawdown at the end of the month, not mid-month, it has to be at the end of the month, then that triggers smart leverage. And when I say trigger, because we may not actually go into equities for a while. So think back, I don't remember exactly what month, but September, October 07, I think was the high before the crash. And so as soon as the month end had a 15% loss back in 08, that would have triggered smart leverage. But well, and I pause now as I think about this. There could have been a month where we went in for a month and then got back out again. But let's just assume the market just continued to dribble down until March 2009. We were in treasuries that whole, almost year and a half period. But then when we go back into treasuries, because smart leverage was triggered, if you were going to go into VTI or IWB, you would instead go into SSO, or if it's a 3X, you go into UPRO.
You mean if you were going to go back into equities?
Yes. Well, yes. Smart leverage is triggered. And so once the benchmark index hits positive momentum and says that you go back into equities, you would then go into the 2 or 3X leverage version.
Oh, okay.
Or sorry if I misspoke there.
So basically, you're staying in the risk-off bonds or bond funds until the IWD or VTI shows positive momentum.
Yeah.
Yeah. So specifically, most of my funds are going to be in IWB when they're invested. Mm-hmm. They're going to be in TLT when they're out of equities and in treasuries. And then if smart leverage is triggered, when the call is to go back in equities, then you would go into a leveraged version at that time.
Okay, good. That explains it. Thank you.
Yeah.
Hey, Randy, this is Gilbert. I got to follow up to that question. So when you do the 2X or the newer one, the 2X or 3X, and you're doing that in the smart leverage, so you're holding the leveraged fund. Now, if the signal got you into that, the buy signal got you into that, turn bearish before 12 months, you get out of it, right? You don't hold it fixed 12 months or more.
Absolutely. That 12-month filter that I showed all the examples of, that is only if you would be staying in it up to that point. You know, if you went into a leveraged in the 2X version, if you went into SSO, but 3 months into it, things went south, and the strategy would then say in the 4th month, hey, you know what, we got to go back into treasuries where we have to exit this position.
And so, so the other side of this question is, if the signal continues to be bullish, you sell at 12 months anyway. Is that true?
The 13th.
13. Right,
yeah,
right.
After 12 full months of holding, you would sell at that at the 13th month. Yeah, and that's
but you still
really
keep in equities.
You would, yeah, you would stay in, well, okay, so let's go back to 2020 again, just because that was the most recent time where it happened. So we had a big drop. We went into treasuries, and we stayed into treasuries for a couple months, and then the market started having upward momentum. The absolute momentum went positive, and it said, hey, let's go back into stocks now. So at that time, if you were, you know, if LT gain 2X was there at that time, smart leverage would have been triggered. We had I can't remember the end of the month number, but it was well in excess of 15%. So when we go back into equities, you would go into SSO, and it held for the next 12 months. The strategy each of the next 12 consecutive months said equities, stay in equity. So we would hold SSO, and the 13th month also said stay in equities.
Right.
However, as I mentioned earlier, I have 2 goals on that 13th month. One is to de-risk, and one is to lock in long-term goals.
The gain, yeah.
So we do that we exit the SSO and we purchase IWB instead. So we're still in the market. We're just going down to a 1X instead of 2X.
Oh, okay, great, thanks.
Yeah.
Can I ask a different question then?
Sure.
On your the most conservative triad strategy,
Yep.
I see you say you put 1/6 into the gold,
Right.
and the other 2 IWB and IWS are 1/3 each. So there's 1/6 missing. Is that in cash?
So right up, see here, can you see that screen where it says 1/6 gold and 5/6 VGSH?
Yeah. Well, the question I was asking was, the description on Triad says, if you look at the yellow heading below, says invest 1/3 into each of the 2, and then 1/6 into gold. So you're missing 1/6 out of the total.
Well, no, I'm not, because it may invest up to 1/3 in the Russell 1000. It may invest 1/3 into mid-cap value, and it may invest 1/6 into gold. Right. Anything that's not invested into those is going to be in the treasuries.
So the other 1/6 was whoever wins on those 3 treasury or bond.
To phrase it another way, you're always going to have at least 1/6 in treasuries. Well, I say treasuries, but it could be corporate, short-term corporate bond too. But yeah, you're always going to have 1/6 minimum out of equities and in bonds / treasuries. Yeah.
Got it. Okay. Yeah. Thank you. Excellent.
Okay. Anybody else?
Well, you guys are letting me off easy.
Okay. In that case, I ask another question. So is it true that the difference between the LT gain 2X versus LT gain 3X is really only in smart leveraging, whether you do 2X or 3X?
Correct.
Okay, good.
Well, okay, that's not totally true. The other difference, and if you look at the bottom there for February and March, you'll see that LT gain 3X uses EDV, and 2X uses LTL.
Right. Okay.
Or TLT.
TLT, yes.
TLT. Yeah. And I do that I'm just trying to scale appropriately for the strategy. So the one that's using some 2x, I want to be a little more conservative when I'm out of equities and into treasuries. And a person who's going to go into 3x, I assume they want a little more chance of boost in the returns when they're in treasuries. So I went EDV.
Okay.
There is a reason for the madness, I assure you.
I'm pretty sure. Yes. Excellent work. I may be wrong, but I have the impression if you can scroll back to the latest allocation per se, like end of February, where things are.
I mean this one here?
Yeah. If that's the case, how can LT gain 2x versus 3x have a different monthly?
Because the 3x is using EDV as opposed to TLT.
Oh, right. I keep on forgetting.
We've been in treasuries from February forward.
Yes.
So the 3x has seen a little worse performance because we've had a drawdown in the treasuries.
Right. Absolutely correct. Yes.
Yeah.
Got it. Thank you.
And for anybody who hasn't invested in dual momentum themselves before, I should just point out that I think it's really important that people understand, and let me go back to, this isn't the best chart to show it because it's, the performance on those top two is so huge, it kind of mutes the drawdowns of the S&P. But the day-to-day, the month-to-month, even over a couple-year time period, is not when you're likely to see the biggest gains that dual momentum or for LT, single momentum is going to offer you, right? And said another way is, during relatively short, quick drawdowns, you may do a little better in these type of strategies than a buy and hold. You may not do better, right? I mean, at the end of 2018, when we had that dip in the markets and then a rip right back, my strategies actually had us out before December, and I was using them back then, even though I had it was mainly Global Navigator at that time in the Russell, but they got me out of the market. And by the time the end of February, or maybe it was January of 2019 came, I really had no performance gain over the market. I did, however, sidestep a decent sized drawdown, so that was kind of nice. But at the end of the day, I really didn't get an outperformance at that time period. And it was the same situation in 2020. We recovered so incredibly fast once we hit bottom that if you forward to, like, say, June, the Russell and Global Navigator had almost exact performance year to date as the S&P. The difference is, though, that my strategies, when I say my strategies, because I was definitely in the Russell and Global Navigator at those time, and I've made a lot of changes since then. But those two strategies only had about an 8, maybe 9% drawdown at the start of 2020. Whereas, not on a month-end basis, but intraday, the S&P was down 33, I think maybe 35%. So I didn't gain midway. When we got to midway through 2020, I really was plus minus almost zero to the S&P, but I sidestepped, a 25% drawdown getting there. So that was nice. But the time when you're going to see the biggest gains to one of the, basically to strategies like mine is in when the dot-com bubble burst in 2007 through 2009. It's those long protracted drawdowns. They keep you safe, keep you out of the market, and it preserves your capital, and it gets you ready. And as the strategies are today, it gets you into smart leverage when you get back in. That's where you get the real performance advantages. I don't have it up here, but last year, well, actually, I guess I kind of do. Let me go back here to, you can see this is last year's. So you can see, if you look down at the right, the very left column near the bottom, 2020 and 2021, 2020, basically all my strategies did really well because they got into smart leverage. That's why they crushed the S&P that year. If you look at 2020, okay, well, Triad actually underperformed the 60-40 a bit that year. The Russell OG, which doesn't use smart leverage, barely underperformed. Well, I'd say barely, 3%, but it was close to performing the same as the S&P. Global NAV actually did a little worse. And I remember that's because it went into foreign, and then foreign kind of puked, and we got stung a little bit by that. But then if you look at the LT gain ones, they just absolutely crushed it. And again, they were in some leverage in that time period early in 2021. But I guess maybe the global OG is the one to, I'm sorry, I mean, Russell OG is kind of the one to more compare to the S&P directly because it doesn't use smart leverage. But if you go up and look at, 2007, 8, and 9, you can see we almost doubled the performance in 07. We, instead of losing 37%, we made 34% in 08. In 09, we didn't do as well because we were out, again, if you remember, we dipped at the very bottom. I think it was March 15th or 20th or something. We hit the bottom. So it took a couple months of positive momentum before the strategy got back in. But, if you were invested in the market during that time, you may remember personally, or people you knew who were down 30, 40, 50% in 08. It would be a lot easier to stomach that had you been up 34% that year. You wouldn't mind so much giving up 20% the next year, because then you're back on track after that. You start performing well again. And so anyway, I took a little longer than I hoped to explain that, but I just want to let people know, though, that these are not strategies to beat the market on a daily, a monthly, even an annual basis. You're really looking to outperform in those longer drawdowns where buy and hold is just really painful, and you're questioning why you're in the market during those times. You're not in these strategies, you're out. It's fits my mentality and temperament far better.
Well, you realize that this sort of fits into a general philosophy here, though, that if you have some trading system that gets you out of the market during the disasters, the biggest drawdowns, so if you avoid the disasters, the other alternatives are all pretty good, right?
Absolutely. And if you look at like Gary's GEM strategy, the godfather of dual momentum investing, he doesn't go into any treasuries. He goes into the ag bond market. And obviously, I've chosen not to do that. I've used different duration treasuries for my strategies. And for me, that's the right call. Although, for Triad, I use short to intermediate at the longest term. But I'll tell you, for each individual person, that's something you have to assess. And I don't think there's anything wrong with going into the ag bonds whatsoever. It's far less volatile. You get less drawdowns. You also get less gains over time. But if that's when the market's, when it's hitting the fan and you just want to kind of sit on the sideline, hey, ag bonds is not a bad place to be. I don't have a problem with that. I'm personally trying to not be super aggressive, but I feel like the treasuries are more my speed. Yeah.
Okay, anybody else?
Well, I had a quick question, and that was, I guess you have it in your slides somewhere, but where's your farmer strategy detailed?
Where's the what detailed?
Farmer.
Oh, profit farmer. Yeah. So I track it in my strategies are all tracked in a massive Excel spreadsheet. This fact sheet came out of there, but I don't actually publish it because it's not my strategy. It's a guy, he goes by the handle Private Farmer. I met him on Boglehead quite a while back. We kind of touch base through there, and he contacted me. He was interested in using some of my strategies, and I was interested in his. And so I actually just recently put it into my models because I've got a pretty big allocation to it, but I don't actually I don't report on it just because it's not my strategy.
So where can I find out about it again?
If you shoot me an email, I'm happy to send you the portfolio visualizer link. And by the way, I should mention one of the reasons, well, there's two reasons I don't report on it. One, it's not mine, it's the third parties. And second, calculating, I actually had a different asset allocation, adaptive asset allocation model that I was using for a while, and I had it built into my model, and it just doesn't fit well. My model is really built for month-end numbers, and you have to have daily performance figures for adaptive asset allocation. So I don't model it myself. I get it out of Portfolio Visualizer. And to get the forward month investments for an adaptive asset allocation out of Portfolio Visualizer, you have to be a subscriber at $240 a year. So I think it would be wrong for me to put information for where that strategy should be in the current month if it's subscriber only data. I mean, I pay for it. I actually have a paid account, but I don't think it'd be right of me to publish that for other people to use.
Not a problem. I understand it. It looks like you got a fair amount of faith in it, though, given your allocation. So I'll send you the email. Thank you very much.
Hey, Bill, it's a minimum variance, 2-month look back.
Yeah. And three asset allocation. Yeah. Which is odd because it sometimes only uses 2 and sometimes only uses 1, but I guess that's
well, the minimum variance algorithm will pick whatever's required to get to the minimum variance, and if you give it 3 like it asked for, it might end up with 3 or it might end up with 1.
Gotcha. Okay.
So you have that, Don, is that then in one of your, when it was that, does that have an S number in your thing?
Well, it doesn't have an S number, but we do have the minimum variance calculation in some strategies. In fact, Niraj, his strategy used minimum variance, and so I do calculate that. Cool. I mean, it's in, we've got that algorithm in our toolkit.
Thank you.
Yeah. And knowing what the assets are, you could a Portfolio Visualizer free version will give you what the allocations are for last month.
Only for past months, though, not for the current month. Yeah,
that's true.
So Randy, can I ask a quick question on this one?
Sure.
Is there a timer on this? In other words,
no.
This is always just okay. No timer.
Because it's got TMF in there, so it can be its own timer.
Right. Okay.
Well,
and that's why it doesn't do as well during the long drawdowns like 07 through 09, 2007 through 2009. It doesn't have that flip the switch to get out of equities. But the flip side is that it can do spectacular when things are hitting on all cylinders.
Right.
One thing, I guess I do have one other question. If you go back to this couple of slides where you wind up showing your wonderful performance, 1980 through February 8, 2022, you go, it's kind of notable in that, it's the green with all the greens in it. So it'll wind up in my thing.
Oh, the annual numbers. Yeah, sorry. Here we go.
Yeah, there you go. The don't have that many red stripes all the way across, and the only time you go in and have anything with approaching the 20%, in fact, was the 2015, 2005. Do you think the years? This is something awful to ask a guy like you, but I'm going to ask it anyway. Do you expect these numbers to go on to start turning green this year, or is what are your expectations on that? Some of these things, for example, 2014, that's around when they wound up invading Crimea too. So
yeah. I'm going to defer that question to I'll answer your question, but I personally, I'm not I'll do some very minor technical charting things. I'm not a forecaster of the markets, which honestly is one of the main reasons why I use my own strategies. They do it for me. I don't have to think about it. I do what they tell me to do. But I will mention that from Piper Sandler, Craig Johnson is their lead. I don't know what his title is, but if you look him up, it's Craig Johnson, Piper Sandler. He's their lead technical stock guy, and he's been insanely accurate the past many years calling where we would end the year from the beginning of the year. And he originally had the S&P for 2022. He had it set at 5,150, and he's recently downward revised that to 4,750. So he sees 400 or so points from where we are currently upside. And I'm going to tell you, he's a much better forecaster than I could ever be. So that's my best guess is he thinks we're going to have a positive number at the end of the year.
Thank you very much.
Yeah, yeah. And by the way, you mentioned not much red on here. The triad's a little different. The other are all dual momentum, but they are all timer strategies. So they do tend to have the same negative years. But you'll notice we are negative this year. It's still early, but 15 was not a good year for timing strategies. But you'll see, other than Max Payne, they were really only down a few percent. Global NAV was down 8, and I'm guessing that was because it went into foreign.
And to your credit, Randy, it's also very early in the year. I mean, we're only.
Oh, absolutely, yeah, we're just barely over 2 months in, right? Then you look back to 1994. We had negatives there, but again, only a few percent for the year, not much, and just a little higher in 1990. 87. I'm guessing global NAV must have gone foreign and it did better, which is why that one's positive. But again, the negatives for the year, they're not very big, But then look over at the S&P, not bad until we get to 2000, but then you've got 3 years in a row with 10, 10, and 22% drawdowns, 36. Those hurt. Those really hurt. So,
and your strategies look like they were the place to be as opposed to the index. So good job there.
Yeah, thank you. And full credit. Gary is the one who brought dual momentum up, I think, but it really resonated with me, and my tinkering with it ended up with these strategies, and I've got my money in them myself, so I like them.
Okay, Randy. Well, the next time you come up with some more, we'll have you back again if you're willing.
Sounds good. It might, I don't know if it's of interest to the group or not, but I could probably do a presentation on some of the work I've been doing around the retirement withdrawal information. Might be of interest.
I say, please do it.
Yeah.
So I'm going to leave a little cliffhanger with regards to that. You guys may know Portfolio Charts. Tyler's the guy who runs that. And I don't say it casually as though we're buddies. We've emailed a little bit. I just don't know his last name. But I did reach out to him a while back because I liked the charts that he showed on his drawdown calculations for the permanent, or I guess a safe withdrawal rate. I think he did 35-year period, if I remember. But I kind of asked him a little bit about it, and I showed him what I was doing and what I was looking at, and I came to find out through this that once I understand how he does it, I don't like what he does, and I say that because he's only using annual return data in his numbers. He doesn't look at monthly numbers. So he had absolute no idea what the drawdowns were, only that a withdrawal rate passed or failed. And not how I operate. I wouldn't want to know that I was invested in the S&P from 2007 through 2000 whatever, maybe 12, before you got whole again. I don't want to just know, hey, we made it, it worked, the markets came back and you're okay. I need to know that we took a 50% drawdown during that time. That's pretty important information, in my opinion. So I have a little different criteria in how I look at it, and I absolutely take drawdown data. It's one of my primary factors, actually, that I look at, and I think he's going to change his data too. He looked at what I had, and he was pretty intrigued by it. So we'll see.
Well, I think we're all on the same side as Gilbert, and that would be very interested in having you come back. Your stuff is very informative, and there hasn't been a single question I've asked that you haven't been a great answer to. So thank you so much for coming and giving your presentation. I certainly found it valuable, and I know everybody else did too.
Well, you're welcome. I appreciate that. It's nice to hear. Thank you.
Okay, well, thanks again, Randy, and we'll see you next time.
Okay. Thanks, Don. Bye, guys.
Bye-bye.
Thanks, Wendy.
Thanks, Randy.
Bye, Randy. Thank you.
Yep. Thank you.